Hello everyone, welcome to FISC Financial Strategy Consultants. Today we are going to study CFA Level 3 reading number 7 LOS 4. This is the final LOS of this reading where we are going to understand what traditional and behavioral finance perspective is on capital markets. So first of all, what is traditional perspective on market behavior? We have already understand that traditional finance believe that markets are completely efficient and they incorporate all the instantaneous information, all the accurate information and show it in the market prices. There are three kind of efficiency which has been discussed in the traditional finance. The first one is weak form efficiency. In a weak form efficiency, the market is considered to be such efficient that any kind of technical analysis won't give you any excess return. The second one is semi-strong efficiency, where it is supposed that the fundamental analysis will also not give you any kind of excess return. Whereas in the final one, a strong form efficiency, it is supposed that not even the material non-public information can give you any kind of excess return. So all these kind of information, fundamental, technical and material non-public information is already included in the market price. This is what traditional finance believes. Now it is true that the strong form efficiency is not possible because we can clearly see a lot of example in the market where people are getting advantage of having material non-public information. But there is some support for weak form efficiency. One of them is Malkiel-Cointos theory. What he did was he selected 50 students and then he provided them coins and he made charts from their coin tosses. If heads come, he just move the price 50 cents up. If the it tails, the price goes down by 50 cents, and this goes on. And he created a number of charts and then he showed it to analyst. That analyst do some research and then he suggested that you should sell all your holdings in that particular stock. What then Melky did, that he explained to him that the chart is basically based on coin tosses, not based on the prices of stock. So you can understand that how random the price movement is. It is as random as a coin toss. That means that technical analysis, technical information doesn't really explain you what the next price could be. There is also some support for semi-strong form efficiency. One of the example is stock split event, where you will see that when the announcement is done, the stock prices started moving up. But actually, after the stock split, the market remains constant. That means the information of fundamental analysis is already included there. Also, that there are a number of mutual funds which didn't get any excess alpha as compared to the market. Both of these examples explain that the fundamental analysis doesn't really help you in getting any kind of excess returns. So these are some supports for semi-strong form efficiency. Now, it doesn't mean that this efficiency is completely explaining that markets are efficient. There are some anomalies. One of them is fundamental anomalies. For example, the returns you get from value stocks is much more than the return you get from growth stock. Similarly, small capitalization companies is more than the return you get from large caps. So these kind of returns data historically has shown that there are some explanation from fundamental analysis which help you in getting excess returns. One of the reason is that people generally underestimate the value companies and overestimate the growth companies, and that leads to value in companies performing better in the long run. There are some technical anomalies also. The moving average anomaly, where whenever the price of short horizon, short moving averages of 1 to 5 days surpasses or crosses above longer time horizon moving averages like 50 days, 100 days, 200 days moving averages, that time a signal is for buying the stock. And that really happened, that stocks started going up based on these moving averages. Similarly, support and resistance are really having some practical applications. There are a lot of times that prices moved down from resistance and moved up from support. So this really explains that support and resistance do exist in the market. That means technical analysis can give you a better understanding of future prices. There are some calendar anomalies also, which says that in January you get a higher return, in end of the month and the starting 4 5 days of the month gives you higher return. There are some other anomalies also related to calendar, and that clearly explains that conclude that market is neither efficient nor anomalous completely. It's not a black or white thing. It's more of a gray kind of behavior which market shows, where there are chances that it could behave as an efficient market in some cases, whereas there is also chances that market can be completely anomalous. Now, one more challenge to efficient market hypothesis is that EMH expect that market will always be same and correctly reflection of prices. But there you can see a lot of markets, a lot of stock exchanges showing different prices for the same stock, and that happens because of brokerages and taxes. So the difference of brokerages and taxes is so much, the cost of those things is so much that even if you are seeing an opportunity for arbitrage, you won't do it because of the cost you are going to bear will be more than the profit you can get from that arbitrage, and the price will remain different on the different stock exchanges for a longer time. So that limit of arbitrage also explain that markets are not completely efficient. So this is from the traditional perspective. Now, as we know that the market is not efficient, then how market is? So there are a number of theories provided behavioral finance over it, but none of them is actually accepted by a large majority, and that's why traditional finance perspective is always considered to be dominant over the behavioral finance perspective. But still, there these theories are getting acceptance over the years, and that's why we are studying four of them. First one is consumption and saving approach. In the traditional finance, you suppose that you have a set of money in which some of the money you have to spend and the rest of the money you have to save. But in behavioral approach, the thing is not as simple as traditional. Here you have different buckets, different sources of income, and you assume that the current income portion of your income of your money is the one which you have to spend. The future income is the one which you have to save, and the current assets are the one which you can use in any manner, saving and spending depending on how much income you have in current income to spend. So if your current income is already complete finished, then you can start spending from current assets. So that's the way you generally go in your life, these three buckets. So that is the behavioral approach of consumption and saving to explain the market behavior. Now there is another theory which is called behavioral asset pricing. In behavioral asset pricing, first of all, you already know about capital asset pricing model of traditional finance. In behavioral finance, they have added a sentiment premium based on the analyst estimates. So the more dispersion we see in the predictions of analysts, the more sentiment premium we have to add in the price of a stock. So that's in the required return of a stock. So that's called sentiment premium, which we have to add to make a behavioral asset pricing model. Now the third theory is called behavioral portfolio theory. So as you know about Markowitz portfolio theory, which says that you make your portfolio based on risk and return. Behavioral portfolio theory assumes that an individual doesn't make his portfolio based on risk and return, but he makes a layered portfolio. That means he makes multiple portfolios, two, three, not a single portfolio, and all those portfolio are based on what kind of goals he has. For example, if he has a goal of education loan payment, then he become less risky there and start investing in some risk-free assets or bonds, such kind of investments. If he has a goal of going for a world tour or something like that, he may want to use the higher return to go for such tours rather than investing a lot on risky investments. Rather than saving a lot for such tours or holidays, he would like to invest a lot of money on risky things so that he can get better return and can get a luxurious holiday for himself. So these are the different goals which he has, and based on that he makes different portfolios. So there are five factors which we have to consider before making a portfolio according to BPT. The first one is that you have to make a portfolio based on layers, and those layers will be decided based on the goals you have. So you first define all your goals and then you assign some importance to those goals. Like primary importance would be given to the goals like education for loan payment, whereas secondary goals would be like purchasing a second house, second mortgage, or going for a tour, this kind of thing. Now, based on the kind of layer, you will define which kind of assets you really want in it. The higher goal you have set means higher return you are expecting, you have to invest in riskier investments. If the goal is lower, like a 2-3% return or 4-5% return, you will go for more risk free or near risk free securities, this kind of thing. The third point is that the number of asset will depend on the risk averse behavior you have. The more risk averse you are, the more number of assets you have in your portfolio. Now the fourth point is, if you feel that you have informational advantage on something, the lesser number of assets you will have, and their position will be more concentrated. So if you are working in a particular company, suppose a chemical company, you believe that you have more informational advantage about chemical sector and especially your company, and many times you may have a concentrated position in that particular asset. So these are the things which you have to understand. The next point is, investors are reluctant to realize losses and may hold higher amounts of cash so that they do not have to meet liquidity needs by selling assets that may be in a loss position. The last theory is called adaptive market hypothesis. Efficient market hypothesis, the behavioral finance include natural selection, adaptation, competition, this kind of factors to create a adaptive market hypothesis. And this hypothesis basically explains like individual always work in his self-interest and make mistakes. So whenever he makes mistakes, he try to learn from it and change his strategies. So he is not a rational economic man whose first decision is always best. He makes decisions which could be wrong and then he changes it, so that he is changing again and again to become fittest for the survival in the market. So there are five implications from AMH which we have to study. The first implication is that the relationship of risk and reward varies over time. There would be a time when people become very keen to get risky returns. So if you see historically, people in the earlier days were used to be more risk averse. They used to invest in the securities which are giving constant and definite returns, even if the return is less. Nowadays, people are moving on for very high returns, like venture capital investments, or even if uh, as individual is going for startups rather than a job, this kind of thing. So with time, the risk and reward relationship changes. The second thing is, and that depends on the competition in the environment. Nowadays, we see a lot of competition for very small jobs, and also people are moving for more riskier things to do. The second one is, active management can add value by using arbitrage. So that means that if you constantly look for arbitrage opportunities, you are definitely going to get some, and that will help you in getting some excess return. Another point is, any particular investment strategy will not consistently do well, but we will have periods of superior and inferior performances. That means that no particular strategy is best at every instant. Just if you know, like there are different strategies which we have to apply to get excess returns. There could be some times where a moving average can work for you. There could be some times where EV by EBITDA ratio can work for you. There could be some times where price earning ratio could work for you, these kind of things. So there are different strategies, whether it's intraday trading, long term trading. It depends on the timing, on the situation, and those works for you. Sometimes short term investment is better for you, sometimes long term investment is better for you. So all these changes, no strategy is best for a longer term. The fourth point is that a person always try to adapt and innovate himself to be critical to survival. That means he always wanted to be in the market, that's his primary goal. The last one is, survival is the essential objective. That means the return, the amount of profit he is going to get is all secondary to him. the primary importance he give is to the survival of himself in the market. So this is what all we have to study in the last LOS of reading number 7. Please comment to let me know how you feel about this video and how I can improve it. Please share this channel, please subscribe this channel. Thank you very much.